Good morning, ladies and gentlemen. Graeme Holm here, aka the Money Mentor. As always, each week with the brilliant Dr. Andrew Wilson from My Housing Market. Good morning, Doc. How are you?
Yeah, good day, Graeme. How are you? Happy November. Here we are, second last month of the year. Happy November.
Well, very happy November, because I've got an image on screen here, and I just wanted to get your take on this, because I find this, I say to people, don't listen too much to the mainstream media, because if you take your investment, economical, real estate, car choice, if you take your decision-making guidance from the media, it could be a little bit skewed to grab a headline and some clickbait. Now, I want to play this for you, Doc, to get your reaction on this video. I'm not going to comment. I'm just going to press play, Doc. Let me see what you think of this, please, out loud. Let's have a look.
Property prices look set to surge next year, according to leading economists. They could rise by as much as 7% through the 2024 financial year. Experts are pointing to relatively low housing stock combined with a resurgence of buyers.
What do you
Wow.
what do you think of that, Doc?
Well, look, when I saw the surge in prices, I thought, oh, here we go. 10%, 20%. We either have boom or doom or gloom, bust. It's either one extreme or the other. And I thought this was going to be, some sort of a 15% increase or something like that. But it was 7%. And over the financial year, today, Graeme, we're going to have a look at the latest October quarter house price report, hot off the press from My Housing Market. And we're going to see that, 7% actually probably going backwards. It's not a surge, because we've had a very strong and continuing to have a strong second half of the year. Well, full part of the year, really. The calendar year for most capital cities will produce double-figure results, Graeme. So here we're talking about, the first half of next year actually being, less robust than this year's results. So I'm not sure the word surge is applicable. And there was also the usual qualifiers up to, and I'd like to know who these leading economists are. I hope they're not the ones that have been providing the forecasts over the last few years, or maybe over the past decade, that have been so abysmally wrong in terms of outcomes. And we only have to look at this year's results and look at the
7%, Doc. I mean, that's going to be lower than our current growth rate.
Yeah, that's right. So I'm not sure where the surge comes from.
Surge, or would that be a slowing market if it only grew 7%?
Well, look, we haven't put our forecasts out yet for next year, Graeme, but we've had a catch-up year. We've had a catch-up year this year. It was always going to be a stronger year than last year, even with those higher interest rates, because of the factors that we've discussed here really from the beginning of the year. And we discussed it last year as well, that we believed that markets were starting to revive. And, we're on the money again. And so once we've recovered, it's going to be slower going, because we're not recovering, if you understand what I mean, because we've finally got back to where our prices were at their peak last year. And therefore, we can really only grow as incomes grow, or as, we get more affordable drivers of the property market, such as lower interest rates, which isn't going to happen, in my opinion. So it'll be steadier growth next year, but I'm not sure we'll be describing it as a surge. We've had a surge this year, there's no doubt about it, compared to last year. But, as you said, Graeme, it's all about, what we try to do here is to provide credible insights for those that are engaged, particularly in making decisions in property. So, they can have all the best information available, that they can make the best decision, not based on, as you say, the vagaries and the agendas of the media, which aren't really about, let's face it, about making the best decision. They're about looking at the headline, boom, doom, bust, crash, all those sort of things are designed to gather clickbait. So, but I guess that's another example of that, Graeme. But, different agendas. Our agenda here as part of property media is for those that listen to us to make the best decisions. And I think, we've got a pretty good track record, have we not?
Well, yeah, we've been right a fairly large percentage of the time, although we haven't been pessimistic at all, Doc, because the data didn't support pessimism. And we haven't been optimistic. I think really we've been realists the whole time based on interpreting the data.
Well, that's what we're here to do. We take a scientific approach to the market, Graeme, and
if it's bad, it's bad. It's good, it's good.
Yeah, and we support what we say through evidence-based research, and is that not how you should do it, rather than any sort of other agenda? And we also have a very solid, more than solid, robust back end of data that that our own in-house data that we use as well to support our positions. And as we always say, we're all about trying to get to the real time, to here and now in terms of property, not backward looking. Those that have been one of the longer term providers of data, Graeme, in the marketplace, have just released their September quarter data. And here we are, it's the 1st of November, and we're talking, other providers are talking about what happened 4 months ago, 5 months ago, going back to July. So who cares about July? And of course, July, we just started to pause rates, blah, blah, blah. Now we're looking at raising rates again, perhaps. So we try to get to the real-time nature of the market, so decisions can be made based on what's happening now, not what's happened months and months ago.
Now, Doc, I kind of like this word now, so I'm going to steal it. Can we surge on into some realistic data? Because I kind of like that word now.
Yeah, it's a good
and the market is surging ahead.
Yeah, I guess you got to figure out what a surge is. I'm not sure. I suppose it's where you're coming from, but certainly, markets are not surging now; they've already surged in a sense. And in another way, property markets, and it depends on your time frame that you're looking at, don't really surge. It always comes from a position of, predictability in a lot of respects. Now, we were a year ago or more. In fact, last September, we started to say the market was turning. That's last September, because we started to look at the improvement in auction clearance rates, and they did start to improve in September. And even though prices were still falling, the rate of decline had actually started to ease. And we said at the time, look, these are the signs that the market is starting to turn, that it had reached its trough, and that we said that given the drivers, and, we mentioned all those underlying drivers, lack of new building coming through, surging migration, there's that word again, surging migration, and affordability, because prices had fallen, would start to bring buyers back into the market. And Graeme, that's exactly what happened. And yet at that period when we were saying the market was turning, the media, as we've looked at today, were promoting what's the reverse to surge, collapse type of scenarios for house prices this year. They were still saying, no, 10%, 15, 20% falls in house prices, even though there were clear signs there, which we were telling people about, that the markets had actually started to turn and had bottomed out. And we were using real-time data to reveal that, particularly what happened was happening in auction markets. So be wary of, if you're making decisions in property, be wary of what your source is. And, I'm not so sure mainstream media gets the type of views that it would be, that it's hoping it would get. And maybe if it doesn't have the same leverage it used to have, that makes it even more prone to sort of, make up some silly headlines just to drag people in. But I guess it's a bit like the boy that cried wolf, Graeme. Remember that old story as that fairy tale about the boy? Well, it's not that. It's a sort of a fable or whatever about the guy who kept crying wolf, to get attention, and even though it wasn't happening, and then finally they got gobbled up because nobody would listen to them anymore. And that's the problem. If you keep crying wolf, eventually people will just completely ignore you when it's obviously shown to be just a scare scare tactic, So that's the lesson. But I guess there's that short-term view of the bottom line in terms of making profits in the media, and that's all they care about really at the moment because, the media is a whole different ballgame now. There are other avenues where you can promote your product, and here we are doing that now. We're promoting housing market intelligence in another forum, and that means, more competition for what was once upon a time virtually a monopoly on information in the mainstream media.
Absolutely. And Doc, I think, and I might be wrong here, but I think in electrical terms, the opposite of a surge is a sag, but I could be wrong. So if somebody in the comments on YouTube can let us know, is it surge and sag or is it surge and I don't know. But there you go.
That could be right. Anyway, it's an interesting conundrum, isn't it? What's the opposite to surge?
Solving the world's problems on our Wilson Weekly this week.
Yeah, I was going to say droop, but I don't think that's. We could just go through a lot of particular whatever, but we need to talk about what's happened in the housing market this week, and it's been a big week, as we've said. We've released the house price report. Even bigger week coming up next week, Graeme, where we have the Melbourne Cup Day race, which is called, strangely enough, the Melbourne Cup. But we also have the traditional Reserve Bank meeting, which is also on the first Tuesday in November. And it's also a day where the Reserve Bank has used as a day where they've moved. They've actually made a decision on rates either up or down. And I can tell you that one of the reasons that occurs, why it is a day of activity in terms of movement of interest rates, is because it's basically the last month of the year where a change in interest rates has an impact on the market. Because if you think about it, if they waited till December, we're all in holiday, we're all moving into holiday mode, it doesn't have the impact. And then the next meeting is not until February traditionally. So it's their last chance to do something with the economy by changing interest rates either up or down. And this year, even more so, Graeme, if they decide to go up. Of course, they won't decide to go down. If they do decide to go up, it's also November's become a very big spending month because of Black Friday. November
Friday,
now,
Cyber Monday.
November's now the biggest month of the year for retail sales. Now that's taken over from December, which of course is Christmas purchases. That's why December's traditionally been the big month. But November now is where all the spending is happening. So people are bringing forward their Christmas shopping, not just for looking for bargains, but also Christmas shopping to November. So if you're going to move, it makes it even more rational that you're going to try to, because what they're trying to do is stop people spending. Let's be clear here.
Totally.
And we'll look at the latest retail sales data today, which is not good news for the Reserve Bank, let me tell you, even though the ABS is trying to dress it up.
All right, Doc, well, let's jump straight in and have a look at the data, because you and I could waffle on about some of this stuff all day over a coffee or a vino. So, Doc, what's happened lately?
Well, as I said, Graeme, happy November. We're just about to the the penultimate month of the year. So it's just about done and dusted. We had Super Saturday last weekend. Of course, that's the big auction weekend prior to the Melbourne Cup break. We'll look at the results, which were interesting results. Big numbers of auctions. In fact, we had the biggest numbers of auctions in Melbourne and Sydney for over a year. So, how did that occur? But we now have a pause next week for the Cup. Generally, we see much lower numbers of properties in the auction market for sure. But, of course, it's a big distraction nationally, not just in Melbourne. And then we've got 5 weekends left, and that's it, all she wrote for the end of the year. So we've got 5 auction weekends left after that. So that's it. So we obviously know what's happened this year. It's been a positive year if you're a homeowner for prices growth, but virtually across the board. Some exceptions, but the big markets have certainly performed well, but in catch-up mode, because the markets that lost the most last year generally will gain the most this year. However, again, a couple of exceptions to that. So we'll have a look at the latest economic data, Graeme, because we have been discussing interest rates, and we were discussing that, November is typically or has been a month where the Reserve Bank has decided to move on interest rates. I think they will move coming up and at Melbourne Cup. I think they'll do that. We discussed last week some of the narrative from the latest Reserve Bank minutes from their last meeting in October, Graeme, remember? And there was just a sense there that they're maybe just changing their little tone a bit in their narrative. It's just setting the scene. And for the first time, they actually didn't give a forecast for when they think that interest rates will get back to the target range. They have been saying late 2025, but they didn't put that in. Now, that might mean something, it might mean nothing. But they still were they were adamant at the end of the discussion, at the end of the minutes, that, they were determined to get inflation down. That that's the main game, and they'll do whatever it takes to get inflation down, and that they were prepared to raise rates to do that again. So if we put it in context, we've had 5 interest rate pauses over the last 6 months. Now, this is good news if you're a property owner, a mortgage holder, you don't want interest rates going up. It's a tough gig. We sympathise with that. It does put pressure on, landlords, particularly, even though rents are rising. But the point here is we are looking at what the Reserve Bank should be doing in terms of its role in controlling inflation. And I think it's missed the boat here. And we've sort of said that it was a bit of a surprise when they paused. Firstly, in May, it was like, what? You're pausing? Because all the data was just still crazy strong about the economy. There was just no sign of any slowing down. And yet then they paused, then they rose, but then they paused for 4 months in a row. Now, and in all of those months, there's just absolutely no sign that the economy is slowing down. And yet they've been saying, well, we're pausing because we want to wait and see what's happened. Well, nothing's happened, guys and girls, right? This is the point, and nothing's happened month after month after month.
Well, you know what's happened, Doc? Naughty. The bank's margins have increased pretty well compared to where we were a few years ago. That's about all that's happened.
Well, we know that, and that's a whole different story, Graeme, and it's a story of a lot of concern, to mortgage holders, that even though our interest rates, our official interest rates, are the best part of 1% below where they were at the previous cycle, a peak of the interest rate cycle in 2012, our mortgage rates, naughty, are the best part of 1% higher than where they were back in 2012. So we've had a bit of catch-up happening there with the banks on their margins. When we look at the margins between official rates and mortgage rates, they've actually increased by maybe 1% over the last 10 years. So, who's looking after the customer here or the consumer here in terms of, we have only 4 banks. So, who's managing the strong market power that the banks have, that it's not abused to the detriment of consumers. But that's a whole different story, Graeme. But we do keep mentioning it. And I don't think it's bank bashing. I think it's just, a lesson in an exercise in, rational policy, consumer policy. And, governments, I think, got to get onto this if they have the political will. They should have the political will. But as we've seen recently with some other big, monopoly type organisations, I will not mention them, but there's certainly a lot of issues regarding the relationship between governments and big business that, need some examination perhaps. So the Reserve Bank likely to push up rates. A number in the marketplace are now suggesting that will occur. As I said, I think that they've missed the boat to some degree. It would have been better to keep raising rates earlier to try to get a handle on inflation. Inflation has been falling, but basically inflation's been falling because the price of fuel has been falling, Graeme. from those very high levels a year ago. It's been falling, but guess what? It's rising again now. And the fact that it's rising, guess what? Inflation's rising again now. So they can't even really, take, they can't say that the higher interest rates have pushed inflation down, because really it's just been more of that post-COVID price of oil adjustment, So I think the other point that I just want to mention, if we want to talk about, did they pause too early? Does it mean now they've got to go harder? Well, let's hope not, but that might be the result here, that, the fact that they didn't take their opportunities earlier means that they've got to go harder now, because I'm not sure what 0.25% is going to do in the short term to what is still a raging economy, ragingly strong economy. But let's, if we compare with the US, and we shouldn't really compare, markets with each other, although I think in this instance we've got a little bit more rationale to compare us with the US. Now, the US official interest rate, Graeme, is around about 1% higher than ours, right? So they've gone harder. They're up about 1%, and they started from the same position, which was zero, basically. But their inflation is around about 1.5%, depending on what measure you use, lower than ours. So they've gone harder by 1%, and their inflation is lower by 1% or more. So, there's an indication that maybe we paused too soon. We paused before the US. We were one of the first countries to pause, advanced economies to pause our interest rate policy. And now we're back, looks like we've got to get back on the horse again and raise rates. And as I said, I think that comparison perhaps says it all to some degree in terms of where we are. So the latest data, this is probably the icing on the cake, that in terms of a rate rise decision next week. Headline inflation up again, Graeme, 2 months in a row, up from 5.2% to 5.6%. As I said, nearly 2% higher than what the US have. And that followed a rise the previous month from 4.9. This is the September data. And the August data showed a rise from 4.9 to 5.2. So that's 2 months in a row, Graeme. Underlying inflation, which takes out the volatile items, is still at 5.5%. So we're still double what our target range is for underlying inflation. So we're really light years away from getting back to the target, because they use underlying inflation as their target measure. 2 to 3% is the target, and we're at 5.5%. Again, we saw housing as a real driver of inflation, up by 7.2%. Of course, that reflects rents, which are still surging. And as we discussed last week, the Reserve Bank is now conceding finally that rents are going to continue to rise because of a shortage of dwellings or new dwellings coming through and surging migration. Food up again, 4.7%. And the big kicker was transport, which is fuel, up 9.4%, Graeme. And that's after another big rise the previous month. So 2 big months of increases in fuel, and we've had 2 increases in the headline inflation rate. And I think obviously if you can sort of maybe excuse one increase, whatever, but when you're getting 2 in a row, it's really, and you're heading towards Melbourne Cup Day, which is typically a decision day in terms of up or down. I think that the evidence is almost overwhelming.
Yeah.
We don't know for sure, but I would suggest that they'd have to make a move now, because what are they going to do? Wait for another increase in fuel costs next month, and then it's all too late. December, and then they've got to wait till February next year to make a decision. So I think that we're going to, unfortunately, for mortgage holders, get an interest rate increase next week. But
totally agree.
But is it, you snooze, you lose, and we're well below the US with our headline interest rate, with our official interest rate. We're well above the US with our inflation rate, and we were one of the first countries to actually decide to pause. I'm not sure how the logic has panned out there, why they've decided that, but now it looks like they're going to have to get back to raising interest rates again. And is it all about a missed opportunity? And are we going to have even more questions about the competence of the Reserve Bank? And we've been talking about that, everywhere, and everyone has been speaking about that. And that's why we've got now a different environment for the Reserve Bank and a different governor coming into 2024. So retail sales were also up. Again, not good news in terms if you're looking to stop spending, Graeme, because that's what drives inflation, of course. Up by 0.9%. That followed the up by 2% since September last year. The trend is down, but that's only because we had such a massive growth last year through the COVID spend-a-thon, if I can call it that. So that followed the 9% increase, followed a 0.3% rise, 0.9% increase, followed a 0.3% rise in August. And that's the strongest monthly increase we've had since January. So, it's even though it was supposed to be flattening, we've now had a big pickup over the month. The ABS was starting to talk about it, was about, this holiday sale and this holiday sale. They seem to be trying to cut their narrative in terms of the results to a weakening environment. And they've really failed to do that because even though, and they say that we've had this record low annual trend growth. So they're looking at the trend data, not the seasonally adjusted data. And they say that even overstates it because you've got inflation running as well. So that means it's actually lower and you've got more people out there spending. So that means it's lower when you look at per capita scenarios. But when we look back at the levels last year, they were just extraordinary. They're still extraordinary. They're still at record levels, Graeme. And we're like 40% higher than where we were before COVID. So even with inflation and in population, it doesn't cover that massive increase in now that we have in spending compared to the pre-COVID levels that we had. So, as I said, even though the ABS is trying to dress this up as showing weakening, a significant weakening in retail spending, the data just doesn't support it going forward. And of course, this is another reason the Reserve Bank can't point to weakening, spending as part of, interest rates are working, which means that it's even more incentive for them to get back to that. So you can see there that massive surge through the COVID spending period. Look at that. That's unbelievable. Of course, we're flattening out because people have spent all that money they were given through COVID. Hello. But they're still spending. And look how much higher that is compared to the pre-COVID levels, which are typically quite flat. So, any sense of talking about, the trend being low, current trend being low is nonsense when you're not looking at the context of the data in relation to what happened through COVID. Okay, so that's our economic background. I guess we're looking for an interest rate increase next week. We'll know with next week's show, Graeme. Interesting to see how they dress that up. But I think there's plenty of evidence to support the fact that they should raise rates. As I said, it's not good news. We're not celebrating this, but it's a lot about having a missed opportunity, in my opinion, through pausing too soon when rates were too low, official rates were too low, which has obviously been the case when we look at particularly the labour market every week, how strong that's been. So, Graeme, drum roll, here we are. This is the hot off the press, 1st of November, the latest October quarter house prices from My Housing Market. Now, just to lay the context here, we actually have the October house price growth was up sharply. Strong results there nationally. If we remember, we go back to September, Graeme, we'd seen a little bit of an easing in prices were still growing, but the rate of growth had just started to ease compared to the peak results we were getting in June, May earlier, right? But we've now seen that reverse, and we said, affordability issues, higher prices, higher interest rates, high inflation were starting to push buyers out of the market. A lot of pent-up demand had been released. But now we've seen the October prices pick up. So, and I think what we're seeing was the reflection between the winter period, because the September quarter, of course, included July and August, winter months. But now we've got October, which includes October and September, which are spring months. And, of course, we know there's more activity in spring, particularly with higher priced properties, Graeme. So that tends to, I guess, give you the price effect, which ends up with a higher outcome for prices growth. But we know also when we look at the results, particularly over the last month through our auction markets that they've actually picked up a bit. Sydney had a quiet period in September in terms of its auction clearance rates, but it's now starting to pick up again, and results have been quite robust for that Sydney market. So and listings are rising. So as we also get in spring, and so that's another positive, reflection on higher prices, despite having more properties coming into the market. So a very good result there over the October quarter. Again, some seasonality, I guess, playing its way into that. But the housing markets are still generally quite robust, with some exceptions, and we'll have a look at that when we look at the capital city breakdowns. So most capitals continuing to report solid, strong growth over the year to date. And unit prices also had a strong result, Graeme, over the October quarter. So that was interesting because unit prices were flat over the September quarter, but they've picked up again, maybe some seasonal aspects there. So 9 in a row for the national house price, 9 months in a row with quarterly rolling monthly house prices. October up, median national house price there now $1,078,000 and change. So 9 in a row, the median national house price. We look at the results there. The national house price up 0.9%. That's the strongest result for a number of months, Graeme. Sydney up strongest, or another strong result. Sydney up 0.9%. The big performer has been Perth. That Perth market's really got a head of steam up at the moment. It was up 2.3% over the month. This is comparing the 3 months to October with the 3 months to September. So we've got lots of data there to measure. So it's a good, robust result. 2%, Adelaide up 2%, Brisbane up 1.2%. These are strong results, Graeme, from most of the big capitals there. Melbourne has been, as we've discussed, a little bit of a sideways market. I'm not going to say disappointing, but we thought that Melbourne would perform, similar to Sydney this year, but it certainly, dragged the chain. Still growing, but I still think there's some potential for growth in Melbourne going forward. But certainly Melbourne has been underperforming to expectations recently. But when we look at this year so far, and this puts some context into that media report you were talking about, the surge to 7%. So far this year, Sydney's up 9.5% so far this year. Brisbane up 8%. Look at Perth, Graeme, 11.1% so far this year. And the annual results, Perth's up 12%, more than 12% over the past 12 months. Sydney's up 8%, Adelaide up 10%, Brisbane up 6.7%. So, some very good results there on the annual basis. And when we look at the previous peak, there's still discounts available in Sydney notionally. Sydney, even though it's had strong results this year, still 1.3% below its previous peak price, which was in the March quarter last year. So still some discounts on offer in Sydney, which means there's still upside in that Sydney market, and that's why it's continuing to grow, because it's still a notional value market. Melbourne's 3.4%, still below its previous peak. So I think there's some upside in Melbourne, but it has been, as I said, underperformed to expectations. But Brisbane, Adelaide and Perth are all tracking at record levels now, Graeme. So they're all recording, Brisbane, Adelaide and Perth are now recording record house prices. So this is a good result over October. And I would expect that to be a similar result when we get to November, but we'll see what will happen, particularly given with the prospects of an interest rate increase impacting confidence perhaps to some degree. But we'll see that when it actually happens, and we'll talk about that next week. Unit prices, big rise in unit prices, Graeme, after a flat result over the September quarter. Surge in unit prices. Sydney up 1.2% over the month. Similarly, Melbourne up 1.2% over the month. Strong result there. Again, Perth, top performer. It's a smaller unit market, Perth, so we take that with a grain of salt to some degree, but still up 1.3%, and it does reflect what's been happening in the housing market generally in Perth, Graeme, another rise in units as well. Over the full year, over the year to date, Brisbane up nearly 10% for units so far this year. Adelaide up nearly 13% this year so far. And the full year, Sydney units up nearly 5%. I've got to remember that units outperformed houses last year in Sydney and Melbourne, Graeme. So, in a way, it's a bit of a catch-up year for units versus houses this year, if you know what I mean, in Melbourne and Sydney.
Yep.
But Melbourne's unit price is up 1.5%. Sydney's just about back to its previous peak in terms of its record unit price, just down by 0.5%. Melbourne's still some way to go, so there's plenty of value in that Melbourne unit market at the moment, still down by 5.2%. Adelaide at record levels, unit market. Brisbane just about back to its previous record peak, and Perth again at record levels. So there's some good, strong results there, Graeme, for both houses and units in most capitals. Hobart picked up a little bit for units and houses after having been a downwards performer over the previous quarter. So Hobart just starting to reverse what's been a weakening environment over the last few months. And Darwin, which is a very volatile market, because of the seasonality, wet and dry season particularly, and also lower volumes. But all in all, Graeme, maybe to some degree a surprisingly positive result for houses and units, given that we've had some easing over the last couple of quarters. But I do think this reflects that spring energy in the market now, pushing forward not just higher-priced properties, more higher-priced properties, and higher listings, but also, the fact that, that it is a more positive environment for transactions when we do get into the spring selling season. I just thought I sort of put this in. We sort of discussed this last week, but this is the RBA, and we've had a bit of RBA bashing today, which we do a bit of, but, hey, mate, if you earn it, you earn it. You know what I mean? I thought the first thing was that they mentioned in their last minutes that the turnaround had continued in recent months. Yeah, okay, well, we know that. And what they've said here, which was they said upward revisions to earlier data meant that house prices were only slightly below their April peak.
This?
Well,
you're the Reserve Bank. What's this revision bullshit? You're the Reserve Bank of Australia. What are you revising?
That's easy.
Your stupidity.
If you get it wrong, you just say, we revised the data. Don't worry about that. So wherever they're getting their data from, why is there significant revisions? Because there must be revisions of some significance to actually mention it. If it was just marginal, 0.1 here, point whatever, why would you be mentioning it? But, they're now talking about revisions, and that's very concerning. They have a very poor record on housing market analysis. And again, they're revealing perhaps part of that record is the data that they're using, having to be revised. And maybe they could use that as an excuse, saying, well, don't blame us, it's the data, So I think that's an interesting point. They also said that members noted stronger than expected. I've underlined that. That's my underlining. So stronger than expected recovery in the housing market might provide some support to household consumption in the period ahead. I'm not so sure about that. I'm not so sure about particularly the short-term, correlation between higher house prices and people going out and spending. I think it works in tandem with other drivers. It's not about the higher prices. It's just that higher prices are being generated by factors which also mean people will be out there spending. Because if they're buying houses, they're going to be buying other stuff as well. It's not because the prices are higher that they're out there spending. It's the effects on the housing market that generate higher prices are the same that generate people spending generally, if you understand what I mean, Graeme. So again, sorry, don't like bashing the Reserve Bank, but if you earn it, you earn it. And again, some more, I think, housing market gobbledygook from the Reserve Bank, and gee whiz, if they made some blues in regard to that over the last decade or so. And the thing that really worried me here is they're now starting to talk the old talk from the previous governor in terms of, needing to control the housing market with higher interest rates. Are you kidding me? Are you for real? Are you talking this stuff again? Have a look at the rental market. What happened to that when the RBA was part of a system that tried to get rid of, or certainly ease investor activity, And now we're talking about that the rise in house prices might be a signal that interest rates weren't as high as they should be, and that they're worried that they might get more inflation if housing if the housing turnover picked up more than or started to pick up. So that they're again relating the housing market as being a major part of their interest rate or their monetary policy. When it's not a driver of it, it shouldn't be a driver. It's a result of it, right? There are other factors that they should be looking at, not our housing market. And if they start to think about controlling the housing market as being part of the reasons why they will move interest rates, they're going to get back into the same issues that they got back as a reflection in 2016-17 when they kept interest rates on hold because I believe they were fearful of a housing market boom. They were buying into all the bubble nonsense, all the asset bubble nonsense, which was part of the mantra of the Reserve Bank there. And they ended up having to slash interest rates at the back half of 2019 because our economy had flatlined. And that was because I believe interest rates were kept on hold too high for too long because of fears about some sort of an out-of-control housing market. And again, they got egg all over their faces because the reverse happened.
Well, Doc, the Real Estate Institute of New South Wales have actually just released a paper on housing affordability and to both improve housing and rental, ownership and rental. And some of the things they come out with were eliminating stamp duty or reducing stamp duty.
Of course,
wait for this one. Wait for this one. Promote property investment to small-scale investors.
Yeah.
They also wanted to incentivize investors to use long-term stay instead of short-term stay. And I think there are a couple of other things. They were trying to talk about making it easier for homeowners to downsize. They've come out with the basics, but I mean, why is the RBA so fixated on the housing market? There's all these other things in the economy that they're not controlling, and all they ever do is worry about the housing market. Or should we just say, you know what? It's like Australia's whole economy just depends on the housing market. We might as well all be in the housing market.
But they've bought into this extreme theory of the housing market bubble, right? It's the go-to scary thing that, economists by and large have connected themselves to, and it's all fairyland stuff. All you have to do is look at the historical context of Australia's house price cycles, and you see we've just never had that sort of a scenario. And it's because perhaps we're unique, perhaps not, but it is about basically how secure financial system. It's certainly immune from risk to a large degree because we've only got 4 banks. And even though that can mean some perhaps gouging, as we've discussed earlier, it does mean that we're immune from having, too many consumers taking risks with their housing purchases. But it's like, you're putting the cart before the horse here, and it's fraught with danger. And, as I said, it's all about ideology matching the market forces of reality. And we're getting to the point now where that clash is becoming evident, particularly what's happened in our rental market. All these sort of European policies of, public housing or, it's not, higher levels of permanent renters. It's not a part of the Australian condition. And yet we've continued to push policies reflecting that. And this is the bureaucrats and the policymakers who now we have to sort of point the finger at saying, well, why have we got this disgraceful rental market, where rents are only being capped by, the capacity of people to pay more rent. We just have hardly any rental properties. And it is, I believe, because of, policies that have been misguided policies that have been directed to the housing market, particularly through our central banks and other policy makers, which have proven to be nonsense and have proven to cause way more damage than they were supposed to have, fixed in terms of, issues in terms of housing affordability. And as far as the REI and SW, I thought they would have abandoned their Don Quixote tilting at windmills, get rid of stamp duty policy, which has been completely discredited, as was reflected in the loss of the New South Wales government, who went to the people with that policy and they were defeated. Get off it, guys. It's not going to happen. and the logic behind it is just got more holes in it than Swiss cheese. And I think the public out there can see through it. And I think the REI and SW have to look to be promoting the public interest and not their own personal interests if they're ever going to get support for some of these policies. But, and I thought it's interesting. Yeah, all of a sudden they're going to support small-scale investors, and that's what other governments are starting to talk about now, which is like the big 180-degree turn from policy positions, as I said, ideologically driven, that the landlord is the bad guy, the bad girl. We've got to get rid of them, and it'll mean more homeowners. Well, that's been proven not just in Australia but in other jurisdictions to be complete nonsense. Those macro-prudential policies that came out of New Zealand have proven to be, completely worthless. And all you have to do is look at the poor old New Zealand housing market, and they got rid of a government on the back of it, part of it being their terrible housing market, which was driven by those Reserve Bank of New Zealand macro-prudential policies that Australia was all over. They jumped on, oh, yeah, we want to do that too. Sounds great. As I said, this is ideology clashing with reality. And at the end of the day, it's the consumer that pays the price. And if you're a tenant in Australia, we know where we can point the finger to if you're worried about, paying sky-high rents. And it's just mismanagement in terms of policies, in my opinion. So we've gone through a great little RBA bashing exercise. We've also bashed the REI and SW. So we're in good form. So we'll finish off on a more positive note, Graeme. And
sure.
And that's look at the Super Saturday results. Already alluded to them. There's always a big number of auctions prior to the Melbourne Cup break. It's a public holiday in Melbourne, of course, but most capital cities have a hiatus, a distraction through that. But the offset to that was the big weekend last weekend, biggest weekend of the year in Sydney, nearly 900 auctions. Hey, look at that clearance rate, Graeme, 73.8%, higher than the previous weekend, despite, bucket loads of auctions being conducted. Another good result there in Sydney. Melbourne, look at that, nearly 1,400 auctions in Melbourne, Graeme. Massive.
That's huge.
Probably not surprising the Melbourne clearance rate was down a little bit, still not too bad. But as we've said, that Melbourne market's been a little bit sideways lately, still a market that's in favour of sellers, but it's a lot more balanced than particularly the Sydney market. But that was a big number. There'll only be a handful next weekend. Brisbane market, which we say is can be a volatile market, and we take a grain of salt when we look at those Brisbane results. But big numbers in Brisbane, auction clearance rates down. Adelaide back into the 80s, good old Adelaide and its 80% clearance rate, and big numbers in Adelaide. And Canberra fell down a bit also. So Canberra, Brisbane and Melbourne a little weaker under Super Saturday with all those big listings coming through. We look at the trend, Sydney's holding up and again producing so far over October in full now, just a little bit below what it was in September. So still good results there in Sydney. Melbourne a little higher than September, but certainly below its peaks of late autumn, early winter. Similarly there in Brisbane, down a little bit compared to its stronger results. Adelaide back up into the 80s. And there's no doubt the Canberra market has weakened a little bit, softened a bit there, and its results are well below its peak earlier in the year. If you want those auction clearance rates, Graeme, you can get them every Saturday night. You get the auction clearance rate around about 6:15, 6:30 on my LinkedIn channel, Doc Andrew Wilson. They're all the capital city results hot off the press. And you can also get those results of a Sunday morning from my LinkedIn account, which is the full national report, including regional breakdowns in Sydney and Melbourne. So as we always finish off with the giveaway, Graeme, are you excited? I can tell you're excited. For the My Housing Market Infinity app, this is a great little tool. This just shows the depth of our, back-end knowledge. We're not just talking about it. We've also got the numbers, Graeme, so we can provide a scientific basis for those that are looking to find out what's happening today in the housing market in terms of data. So this is our app. If you that's the QR code, you can get a copy of that app. Now, I'll just mention that it is password protected. You have to go through Infinity to get that password. But when you do get it, you'll find a great little app that you can put on your phone. It gives you the current median, high and low asking price and asking rent for every suburb in Australia Graeme, every single one that has some data. If it hasn't got any data, it's not there. And you can also filter it. You can filter it for the type of property, house, unit, townhouse, and you can also filter it for the number of bedrooms. How good is that? 1 bedroom, 2 bedroom, 3 bedroom unit, 4, 5, 6 bedroom house. So you can get hold of that. And just to show you what it looks like, there's a screenshot of the app, Graeme, and you can see that I've just used Blacktown as an example in Sydney for prices, not rents, a house and a 5-bedder. And that shows you that the high price currently is 1.5 million. The medium is 1,230,000. The low price is 850,000, and there are 12 properties for sale. I forgot to mention it. Also tells you the number of listings. So what a great little tool if you're thinking of selling a house, you want to know what the opposition's doing, how many properties are for sale, or if you're thinking of buying, you can look at the trends and look at how various bedrooms are performing, and also townhouses and units. So that's a great little offer that we have here through My Housing Market and Infinity. Next week, we're going to do our rent report, October rents next week. Interest rates, we'll be talking a lot about that. September building approvals, we'll look at that. And, of course, the latest weekend auction results. We've gone a bit over time today, right? But that's because we've been having such a great chat and we've been really let's line it up. Who have we given? We've given it to the media, right? We've given it to the banks. We've given it to the Reserve Bank. We've given it to the REI and SW. So we've had a big day today.
I'll have to add someone else to the list for next week, Doc.
No, give them a rest. I think we're narcs, but no.
Yeah, I think.
Wasn't there an old saying? What was the political party that said about keeping the bastards honest? So maybe that's what we do.
That's true.
We keep the bastards honest. So we'll take up to that one. All right. Well, so good to chat, Graeme. Lots of good stuff there.
Absolutely. We'll see you next week as always. Thank you, Doc.
Good on you, Graeme.
Thank you.
And I hope you're back a winner on the cup.
Oh, no, I don't gamble, mate. I work too hard for my money. I don't gamble.
Yeah, I'm the same. I probably won't even watch it. But
yeah, I'll be working. Yeah,
it's always a good excuse for a party. You know what I mean?
Maybe an office sweepstakes or something, $2.
Yeah. And
good luck.
A couple of glasses of bubbly. It'll all go down nicely. All right, mate. Good on you.
Good luck. Thanks, Doc. See you next week. Bye.